If your stocks are down and you're losing money, then we have some answers for you. And if you have concerns about inflation making your daily needs cost more, and concern about your financial risk from political and military uncertainty and a possible recession ahead, stay with us for the next few minutes. We're going to talk about how to recession-proof your retirement today.
Together, Larry and I have over 70 years combined experience advising retirees about how to bulletproof their finances. We've seen it all, from the market dropping 23% in one day through the first global pandemic in 100 years. And our mission is to help you win the battle for secure retirement income. Today, we give you 5 practical tips to recession-proof your retirement income. And make sure you watch to the end, because I think Larry is going to give you a bonus tip that uncovers how to maximize your retirement income. And we'll also talk about the hidden risk most retirees are unaware of that can cost them over $100,000 or more over the next 10 years. So Larry, what would you say to a retiree who's looking at a steep drop of maybe 30% in their investment accounts today? They're freaking out and they're wondering what to do.
The first, most important thing is not to panic. Look, there is no magic bullet that will make up for those declines overnight. But there are still smart moves you can make, which we'll get to in a minute. People who freak out and react often lose a fortune. You can see that investors earn a lot less than their investments. Why? Because they invest emotionally or try to predict the future.
According to this chart, if you started with $100,000 and relied on your feelings to guide your investments, you'd have $150,000 10 years later. But had you ignored your emotions, you'd have about $260,000 in this hypothetical illustration. That's a $100,000 potential increase, and that's a spicy meatball.
A spicy meatball indeed. And during recessions, you have to ignore your emotions and rather than sell equities, give them enough time to recover. And it's interesting, according to a Fidelity study, by the time recessions are officially announced, they are usually just about over. So in fact, when a recession is announced, it might be time to throw a party because it means good times ahead. Typically, the stock market will begin to rise 6 to 9 months before a recession ends.
Well, that sounds good intellectually, but you have to take steps to make sure you don't overreact. And one way to do that is by having enough cash so you don't have to sell your equity to live on. I'm talking about having a cash cushion. Now, some people think that's not a new idea, but it is a new way of looking at things that can secure your retirement future.
Right. Most people look at their cash cushion as a hedge against losing their job. Retired people don't have that problem. But we're saying you can use your cash cushion as a hedge against market declines, not just as a cash cushion against lost income. So you'd want to have enough cash for maybe 18 to 24 months or more, so you don't have to sell off investments at lower prices. Most people don't think of it that way. In fact, in an upcoming video, we'll show you how to use the bucket strategy to protect against market declines. And if you want to be sure to see that video, make sure you click the subscribe button, and after that, a little bell icon will appear. Make sure you click that so you'll get notified. Hey Neil, what about people who don't have that much cash now?
In that case, use your more conservative investments first. So that might mean selling off bonds before stocks, anything, to allow your equity stocks enough time to recover rather than selling them at the market low. Another idea is to borrow money using margin on your account rather than sell during market declines. This is a strategy that's kind of aggressive because you really don't know how long the market downturn is going to last. But it is an option, and we'll discuss it more in the future. The main point is do whatever you can to minimize or avoid selling equity during market declines, assuming your equity holdings are appropriate. But even that might not be enough for some people, because some of us can't even sleep when the market gets really bad. These people emotionally need to do something, anything, that will allow them to feel a little better. For those people, I recommend making small incremental changes to their portfolio. So sell maybe 5% of the equity each month and add to cash, but not all of your equity.
This is a no-brainer. The retirement crusaders hate credit card debt all the time, but especially during recessions. During recession, interest rates could rise fast, but your savings and investments could decline. So if at all possible, pay off those darn credit cards pronto. In fact, in the description below, we have a link for a credit card that has no interest charges for many, many months, so you can transfer your balance to this card and save on interest while you pay off the balance. This could be as much for your own peace of mind as for your financial security. But if you get a little side job, it could make you a lot less anxious. And the supply of work-at-home jobs has never been greater, so there are a ton of opportunities. If you have clicked the subscribe button below and then the bell icon, we will notify you when we post our video on the easiest ways to generate side income in retirement. With side gig bringing in some income, you wouldn't need to withdraw so much from your other investments, and you could easily give you some peace of mind.
And that leads me to a critical issue and a major mistake that retirees make during market downturns, which is taking too little risk and hurting their financial future. One man I knew predicted the financial crisis of 2008, so he went 100% to cash and avoided the stock market declines, which was great. He sold out where the blue arrow is on this graph, but it ended up costing him a ton of money because he only felt comfortable getting back into the market 12 years later, where the red arrow is. So he gave up all the gains between the red and the blue arrows. So if he started with 500,000 at the end of 12 years, he still had 500,000. Had he stayed invested, he could have doubled that to $1 million. And this is a hypothetical example. I'm not saying you should dump all your cash into the market during a recession. I'm saying having too much cash is also a risk over the long run. For people who have too much cash, now might be a really good time to put a little into the market each month.
Now it's time for that bonus tip. So many people could have 10, 20, 30% or more income with their investments if they understood how to do it. By maximizing income, it helps to minimize the need to sell off assets for cash. Let me say that again. If your assets earn more, you do not need to use principal to support your lifestyle. Some people think that putting money in the bank is the safest place, but the low interest forces you to use principal to support your expenses, and that increases your financial risk during retirement. So, don't let your assets sit around without providing the most income possible. And if you're interested in finding ways to maximize income from your investments, make sure to watch this next video, which is called, interestingly enough, Best Investments for Retirement Income. If you want to watch it later, please remember to subscribe and hit the bell icon so the video will show up for you automatically next time you're on YouTube.